Tonight's Asian Open sets the stage for something far more consequential than a typical trading session. As of now, the cost to hold a standard silver contract has surged from $25,000 to $66,000 in a single 72-hour window. Physical metal is vanishing. Dealers are pulling listings, and national mints are watching inventories drain to zero. The spread between the screen price and what people are actually paying? 91%. That's not a difference. That's a fracture. Something no longer fits. And when Asia opens just hours from now, the global market faces a binary moment. Paper or physical. One will bend, the other may break. Welcome back to the Boring Currency Report, the one channel that doesn't scream, doesn't speculate, doesn't sensationalize. It just lays the data bare. Because sometimes the most quiet voice is the one that sees the storm first. If you've been with us, you already understand the tempo. If this is your first time here, think back to that single family member, the one others ignored when they quietly said, "This doesn't feel right." This channel is that voice. So do yourself a favor, subscribe, not because we promise fireworks, but because when it starts raining, you'll want to be standing under the roof before the clouds break. Trust history. Tonight's story is not financial advice. It's a window. Before we explore what lies on the other side, leave a comment below. Where are you watching this from? Because in 2025, borders may matter, but silver doesn't recognize them. What's unfolding now affects every market that trusts numbers more than weight. It began quietly. On January 28th, the Chicago Mercantile Exchange, often just called CME, tweaked a dial. No press release, no podium, just a silent change to global rules. Margins for holding precious metals were increased across the board. Gold, silver, platinum, palladium, all of them. Then, less than 72 hours later, it happened again. 2 hikes, back to back. Same traders, same metals, higher cost. These weren't token adjustments. These were deliberate, significant increase percentages. Gold margins were lifted 33%, silver 36%, platinum by 25%, palladium by 14%. The financial burden to simply hold long positions is now suffocating for many. But here is where it starts to take shape. The second increase, effective Monday, February 2nd, won't replace the first. No, it stacks on top of it. Imagine pressure applied, not in a flash, but steadily, so traders feel every inch of stress. And silver? Silver is bearing the brunt. After the first hike, it already took $66,000 to hold a standard full-size contract. And come Monday, that number moves up again. Think about this closely. Anyone who was confident trading silver at $25,000 is now being asked to deposit almost 3 times as much. For veteran institutions, that might be tight. For smaller traders, newcomers, or mid-sized funds, it's not tight, it's a wall. It bars entry, it cuts off access. It bleeds reverse momentum into every corner of the demand chain. CME says this is about risk. Market volatility makes it necessary. And yes, silver dropped 31% in a single session just last week, the sharpest daily drop on record. From that angle, maybe they're right. Maybe this is just caution. But the timing speaks differently. Institutions like JP Morgan were observed liquidating massive short positions at the exact bottom of the crash, just before the margin hikes rolled out. Analysts across the commodity space have noted this too, and started to ask the inconvenient question, is this about protecting the exchange or controlling the outcome? Because if the hikes don't just stabilize, if they force liquidations, then every long trader not heavily capitalized is being pushed out. And that leads to one inevitable chain reaction. Selling, not by choice, by requirement. And forced selling, in an already fractured market, does only one thing. It accelerates implosion. So, as we approach the Monday Open, the central question is not if silver rallies or falls. The question is, who can afford to stay in the room? Imagine walking into a store. Every shelf is bare. Not because people have stopped selling, but because there is literally nothing left to sell. That is what is happening right now across the global silver supply chain. While traders obsess over digital charts and headlines scream surface-level narratives, something profoundly more important is happening behind the curtain. The physical market is cracking. Let's begin with Bullionstar, one of the world's most respected names in precious metals. On Saturday, their founder released a trading update. His statement was brief, but the words? Unmistakable. He didn't say it was difficult to source silver. He didn't say it was costly. He said it was uncertain whether they could source any silver inventory at all. In the precious metals world, that level of uncertainty isn't routine. It's a siren, and Bullionstar is not alone. Golden State Mint, another heavyweight in the silver space, shut down silver sales entirely over the weekend. Not indefinitely. Not because demand dipped, but because there was no silver to sell, and crossed the ocean to the UK. The country's largest refiner and precious metal dealer, Baird & Co., also went dark. Silver sales were halted. Their website redirected traffic. No warnings, no dates, just silence. 3 major operations. 3 shutdowns, all within days of each other, all for the same reason: no silver. This is where fundamental understanding becomes critical. For those new to how the metal markets work, there are 2 silvers in play. First, there's paper silver. This is the silver traded on screens, listed on contracts, discussed by analysts who have likely never held an actual bar in their hands. It's theoretical, it's derivative. It represents silver, but it is not silver. Then there's physical silver, the kind you can touch, the kind that needs to be mined, refined, stored, shipped, insured, and guarded, the kind that can't be erased by a keystroke or inflated with speculation. And right now, these 2 markets, paper and physical, are showing wildly different realities. Last Friday, paper silver took a 31% nosedive, a record. Prices plunged on COMEX. Demand supposedly vanished. But in the physical market, that story simply didn't happen. Precious metals dealers didn't see silver being sold. They saw it being hoarded. Mints weren't canceling orders. They were delaying shipments because they couldn't keep up. Demand didn't fade, it surged. This divergence between physical and paper is called a dislocation, a condition in which the screen price no longer maps to reality. And historically, dislocations don't last long, because one side eventually breaks. Either paper catches up, or physical crashes to meet it. Historically, it's never been a fair fight. The grain of physical truth almost always grinds gears of speculation into dust. We've seen this before. You might remember March 2020, the early days of the COVID-19 panic. Dealers dried up, mints couldn't meet quotas, prices rocketed when the dislocation snapped back to equilibrium. What's happening now carries the same markers, and a much larger footprint. So as Monday creeps closer, a second question rises. Not just whether traders are being priced out, but whether the real world, the actual supply chain, is about to force the paper market to reveal its bluff. 2 versions, 1 metal, 2 stories, 1 truth. And tonight, they can't both coexist. There's a moment in every market where the noise fades, the commentary stops, and only the numbers remain. That moment is now. Tonight is not about speculation, it's not about narrative, it's about math, and the math is broken. Let's look at the numbers. Start in Shanghai, China's financial core and one of the globe's most active physical silver trading hubs. As of this hour, spot silver in Shanghai is trading at $122.13 per ounce. Now jump across the ocean to COMEX, the center of the U.S. paper silver trade. On the very same metal, the listed price is $85.33 per ounce. Same planet, same day, same metal. A gap of nearly $37. That's a 43.13% premium. Let that sink in. But that's not the shock. The shock lives on JD.com, China's largest e-commerce platform, where silver is bought not by financial firms, but by regular people, investors, collectors, citizens. On JD.com today, physical silver bars are listed at $163.35 an ounce. That's not a margin. That's a canyon. $85 on COMEX. $163 in China. A 91% gap between paper fiction and physical reality. Silver, in real terms, is being valued almost double in physical form outside American exchanges. So the question becomes, why would anyone, anywhere, pay $160 for something COMEX says is only worth $85? Because they know. Because they understand a truth Wall Street would rather not tell. That truth? Paper silver is not silver. It is a digital instrument. It is a bet. It can be created, leveraged, and traded without a single ounce of metal ever existing. Physical silver, on the other hand, is finite, tangible, costly to extract, ship, and store. And in markets like Shanghai, where insiders with deeper visibility are signaling urgency through price, that premium isn't inflating out of hype. It's forming out of scarcity. Here's the number that may matter more than any other: 130. That is, according to current global supply and demand models, the fair fundamental price for a single ounce of silver, not based on emotion, based on data. At $85, COMEX silver is sitting over 30% below where core fundamentals place true value. Now, here's the part that history makes very, very clear. Every time that kind of discount has appeared, in every major correction, crash, or crisis, the market has not allowed it to last, not once. Because physical demand doesn't fade to suit a lower number on a screen. And producers don't bleed at a loss forever. And informed buyers don't ignore a 30% discount on real value once they see it. The question is no longer whether silver is mispriced. The data already told us that. The only question now is, how fast does the market correct? And that brings us to tonight. All of it, every margin spike, every empty shelf, every premium, every ounce that vanished, it all leads to this moment. When Asia opens, the first real signal fires across this entire system. Because the market has reached the edge, and it has to choose, will paper fold or will reality? This is not a prediction, this is a mechanical collision. And one truth always emerges after the dust settles. So, as the Asian trading window opens, here is what serious market watchers and silent movers will be watching. 1. Shanghai spot pricing. If it holds or rises above $120 while COMEX remains suppressed, the dislocation is intensifying. That is a red flag, a smoke signal. 2. Volume. On COMEX, if volumes begin to spike massively in early hours, traders are not repositioning. They're being forced out. That means forced liquidations are already underway. 3. Dealer inventory. If any major bullion house resumes silver sales, even temporarily, it's a sign that some supply has resurfaced. But if they stay silent, if those stores remain closed, it tells you the shortage isn't just real, it's deepening. This is not about making a smart trade. Not tonight. This is not about flipping contracts or snagging a percentage. This is about understanding what happens when a derivative-based market faces a physical test. Paper and reality are about to get in the same room, and one of them will not walk out.